Good afternoon, ladies and gentlemen and participants. Borrower distress has been on the increase since the outbreak of the COVID-19 pandemic, which saw declining economic activity with significant output losses, liquidity challenges, and disruptions in global supply chain logistics. Financial institutions were also forced to restructure a high volume of their loan book. According to the Bank of Ghana annual report for 2020, the non-performing loan ratio inched up from 13.9 at the end of December 2019 to 14.8 at the end of December 2020 due to pandemic-induced loan repayment challenges and slowdown in credit growth. A timely reorganization of the debt of a financially distressed but viable company may prevent or remedy a loan default in a way that is mutually beneficial to both the borrower and the lender. This corporate restructuring, debt restructuring and refinancing webinar, organized by the UK GCC in the Absa Bank Ghana Limited, the Ghana Association of Restructuring and Insolvency Advisors, GARIA, and Joy Business as media partners, aims to discuss corporate debt restructuring and refinancing as an effective financial tool for accelerating recovery and rebuilding businesses post-COVID-19. Good afternoon once again, ladies and gentlemen. I am Eric Ni Ama Ashie, Director for Global Clients, Absa Bank Ghana Limited. At this juncture, kindly permit me to introduce our chairman for today's occasion. Our chairman for this webinar is a board member of the UK GCC, the head of the hospitality, travel and tour sector, and the chief executive officer of the African Regent Hotel. With a round of virtual applause, let's welcome Mr. John Addo, chairman for this occasion. Thank you very much.
Thank you, Eric, for a nice introduction. My first duty is to welcome all attendees to this webinar. This webinar is most appropriate, especially at this time, given that we are just about coming out of the pandemic. I think in Ghana, we also have this unique situation where we've also come out of banking restructuring. So our banks definitely see businesses differently and are looking at risk differently. Now, I work in the hospitality industry, and for us, in 2020, we were sort of literally closed down. We worked maybe 2 months of the whole 12. And what it means is that after a year and a half, maybe 2 of not really working, we have been financially weakened. Many companies have suffered greatly. But the more important thing is now that we are coming out of pandemic-induced financial crisis, how do we make our businesses sustainable? Because many of us are coming out with debts which have not been paid to various stakeholders, be it the government, the banks, suppliers, etc. Now, in Ghana, we don't have a history of restructuring. And in fact, GARIA, which is a very important institution, which was, should I say, luckily founded a couple of years by my former boss, Mr. Felix Addo, is purpose-built for such an event or such a group of circumstances. And I think the relevance for all of us attending today is to understand how we move from our historic position 2 years ago to what we need to be in order to make our businesses viable within the short to medium term, maybe even long term on here, is that they obviously have a sight of corporate Ghana from a different perspective. And as I've said earlier, the banks also are looking at debt and risk that corporate Ghana is bearing differently. So how do we sort of, if you like, should I say square the circle? It's a bit of an oxymoron. And we've got the right people on the panel to sort of lead us out of the haze. So I'll hand you back to Eric and Obed, who have extensive experience, and also my boss at Pricewaterhouse, Mr. Felix Addo, who is well seasoned, 30 years plus of advisory experience, sits on the board of many blue chip companies in this country, and is also the founder of GARIA. So I'll urge you all to listen attentively and to take copious notes, and maybe after this, we will all have a little bit of a sense of relief, a sense of direction, which will take us out of the rather tight situation that most Ghanaian businesses find themselves in today. So with that, I'll hand you back to Eric, who will sort of lead us through the rest of the webinar. Thank you and welcome.
Thank you. Thank you very much, Mr. John Addo. Thank you very much for your opening remarks. Ladies and gentlemen, before I introduce our first speaker, permit me to share a few housekeeping rules, please. The first, that is our expectation that this webinar will be as lively as possible. So please, if you have any questions, feel free to raise your hand. You'll be unmuted and given the opportunity to ask. Otherwise, you're also encouraged to please put your comments in the chat box. It will also be read for you. Please, let's remember to follow the UKGC social media accounts, which will be displayed on the screen shortly. And if you are not a member as well on this webinar, please, there's opportunity to join. There are a lot of benefits of joining the UKGCC, including webinars like this. There are also sometimes introduction to investors and all of that. So please follow the UKGCC social media portals, and also feel free to reach the office and you'll be assisted to join the chamber. Thank you very much. So at this juncture, I introduce our first speaker for the day. He has 14 years of corporate banking experience and currently heads the corporate debt department of Absa Bank Ghana Limited. He holds a Bachelor of Science degree in mathematics from the Kwame Nkrumah University of Science and Technology, and a certificate in securities and investment from the Ghana Stock Exchange. He has experience across various areas in corporate banking, including deal origination, transaction structuring, and credit risk management. He has been involved in the execution of several key corporate transactions in Ghana in various sectors, including oil and gas, power and infrastructure, manufacturing, and commercial property finance. Ladies and gentlemen, please let's welcome Mr. Obed Ashie, our first speaker for the day. Thank you.
Thank you, Eric, for the introduction. In Eric's introduction, it did mention that I have spent the last 5 years of my banking career in Absa Bank Ghana Limited, out of the 14 years that I've spent doing corporate financing. So I want to take just the next few seconds to briefly talk about Absa Bank Ghana Limited. Now, Absa Bank is part of the Absa Group Limited, a leading Pan-African bank with a proven on-the-ground capabilities across 11 African countries, with presence also in the UK and in the US. Absa has won many awards across the continent, including the Best Investment Bank of the Year in 2021 and 2019 at the African Banker Awards. It has also won the Best Merger and Acquisition Bank in Africa in 2021 and 2020 by the Global Finance. Absa Ghana is the second largest lender in Ghana, meaning we provide significant support to individuals, SMEs, and corporates, helping them bring their possibilities to life. As of June 2021, Absa Bank Ghana has over 1,140 employees, 72 branches, and 166 ATMs across the country. So we want to encourage all the participants who are yet to experience our African heartbeat to contact us online on absa.com.gh or at any of our branches. So to the key discussion points this afternoon: corporate debt restructuring and refinancing. What are we to expect in this presentation? First, we will consider a general overview of debt restructuring and refinancing. And then we will dive into each one of them to understand why assessing a debt restructuring or debt refinancing, the types, their advantages and disadvantages, an example each, after which we will summarize the key points in our presentation to conclude. As we've heard, many businesses are experiencing financial distress as a result of COVID-19 pandemic. So the key question is, how can debt restructuring and debt refinancing be an effective financial tool for accelerating recovery and rebuilding businesses post-COVID-19? Well, this important question will be addressed at the end of our presentation. When you hear the term debt restructuring and refinancing, what comes to mind? Well, often this term evokes an image of a distressed company who is making the last effort to keep its business afloat. Well, this may not always be the case. Often for many companies, or even some individuals, including seasoned finance professionals, the term debt refinancing and restructuring may be lost in translation and may think they refer to the same thing. But in reality, these two processes are different and unique. So talking about debt restructuring, what is it? So at a basic level, debt restructuring refers to altering the terms and conditions of an already existing contract to avoid default. And debt refinancing, on the other hand, refers to the replacement of an existing debt obligation with a new loan, usually with better terms and conditions. So just think about debt restructuring and refinancing, looking at the credit score scale we have at the middle part of this presentation. We see a giant man trying to move the dial of this credit score scale to the right. Depending on the positioning of a company, and to some extent an individual on this credit score scale, determines whether that company requires a debt restructuring or a refinancing. Debt restructuring normally applies to a company experiencing financial distress temporarily and will need some respite so that it will prevent them from defaulting on their loan obligation. So as a company, where do you put yourself on this credit score scale? Is it to the left or to the right? Companies that find themselves to the left obviously may be experiencing some financial challenges, and such companies will need debt restructuring. However, for some, because of improving credit score or credit risk profile, such companies will need a debt refinancing to reorganize their debt obligations, enable for them to inject some liquidity into their business. So again, where you find yourself on the scale, determine which of these tools you can use in reorganizing your debt obligation with a key goal of recovering from financial stress if you are in distress, or reducing your financial burden if you are in a financial situation that you can access a debt refinancing. So why would a company want to consider debt restructuring at the first place? At this point, we want to consider two reasons why a company will consider assessing a debt restructuring. One key reason is that it provides the company the ability to prevent itself from defaulting on its facilities with its lenders or creditors. So a company usually considering debt restructuring is likely experiencing some financial difficulty that cannot be easily resolved. So under such instances, the company faces limited options. One, to restructure its debt obligation, or to default on its loan. Defaulting on its facility means that the company would likely go into bankruptcy or liquidation. A company in bankruptcy or liquidation will lose its assets, and its employees will also lose their job. So to prevent these from happening, a company that is temporarily experiencing financial challenges, but having a viable business or opportunity or operation, will want to consider using debt restructuring as a financial tool to reorganize its debt obligation for some financial relief. For the second reason, lenders or creditors usually do not want their borrowers to default on their loans because of the high cost that comes with liquidation or bankruptcy. So often, lenders prefer to negotiate with companies temporarily experiencing financial distress so that they will continue meeting their debt obligation without defaulting. So some relief that the company may obtain from the lender is reduction in interest rates, extension of loan repayments, moratorium on debt service, mostly on principal repayments, or altering of some of their financial covenants and terms and conditions, or to give them that financial relief. So this is also a second reason why a company will want to assess debt restructuring or restructure its debt obligation. It's a benefit for both a company experiencing this distressed situation and also for the lender or the creditor. So as a business operating, what are the methods or types of restructuring tools available to you? There are three ones we want to highlight in this presentation. The first is debt equity swap. In this type of debt restructuring, a lender or a creditor will agree to swap part or their total outstanding debt with an equity stake in the business. This type of restructuring is not common when it comes to the banks. What we typically see for banks is that they will normally sign a step-in right agreement with the borrower experiencing financial distress that gives them the ability to step in place of the management team, to run the business, to generate cash flows for them to use this to pay their debt obligations without defaulting the client. After debt repayment, they then hand over the business to the business owner. So it's one option that businesses can consider to swap debt with equity in their business. The second option is loan haircut. And this type of restructuring happens when the lender or creditor agrees to take haircuts on their loan obligation. You might be wondering, why would a lender want to take haircuts? Well, this basically means that the lender or the creditor will agree to write off a portion or the outstanding loan amount or the interest just to give the company in that financial distress that relief that they require. And this is subject to negotiation with your lender or creditor. And it's also dependent on how deep the company is in financial distress. The third one is negotiation payment of terms and conditions with respect to the existing loan facility. So as the name itself implies, the borrower will want to renegotiate some of the terms and conditions, which could include financial covenants imposed on them by the lender. It could also include restrictions or dividend payouts and the rest. So the lender in this situation have that conversation with the borrower, and then they agree on the terms that will be suitable in helping the company have that financial relief that they require. So what are the steps that you are to go through as a business to assess any of these options of debt restructuring? The first thing to do as a business is to understand your current financial situation. You need to understand your needs as a business. What you want to avoid is the situation where default happens before you approach your creditor or lender to consider restructuring of your debt obligation. So after assessing your financial situation, understanding what that means in terms of your upcoming debt repayment obligation, then you reach out to your lender or creditor. Then you negotiate the terms of the restructure with the creditor or the lender, and what is finally agreed is then implemented. The key takeaway from this slide is that the process of restructuring is a win-win for both the borrower and then the lender. So as a business, when going through financial distress, don't shy away from having that conversation with your lender or creditor. Don't wait until debt default happens. You can assess this financial tool as a way of rearranging your business and debt obligation to prevent you from defaulting on your loans. What are some of the advantages and disadvantages that come? Well, so a borrower assessing debt restructuring can have access to lower interest rates in some cases. We say in some cases because in other cases, there could be increase in interest rates when you assess a debt restructuring. And there's a reason why. A lender or a creditor typically charges interest rates based on the risk profile of the company or the business, or in some other words, your credit scoring. So assessing a restructuring gives an indication that you are in some sort of financial distress. And that means that your credit risk profile is deteriorating. So as the principle goes, risk and reward, the lender may increase the interest rates on your facility. But depending on your negotiation, you can get a lower interest rate in a debt restructuring. And that other advantage is that it keeps the business afloat, as earlier mentioned. It's a better financial tool in helping businesses to continue operating despite the temporary situation that they find themselves in currently. And it also protects business assets. So there are very good reasons and advantages for a company to consider assessing the tool of debt restructuring to rearrange its debt obligations. But what are the downsides that we want to consider when making the decision to use this financial tool? Well, this obviously will impact your credit scoring, as earlier mentioned. Prolonged repayment period in an event where you agree to extend the period of your loan repayment with your creditor or lender, will come with increased total interest payments on your debt obligation. Because the principle is, the longer it takes you to pay your loan, the more interest you pay on that loan. The number of restructuring a business can also assess is limited, and there are upfront fees or restructuring fees that may apply in such a situation. So again, we want to highlight that a business experiencing such difficulty will want to engage the lender early to have such conversations. So these slides give an example of a company impacted by COVID-19, and a typical example of such a company is one operating aviation sector. Companies also in the hospitality sector were greatly impacted by COVID-19. So such a company in such financial distress will obviously have challenges in meeting their debt service obligation. So such a business can approach their creditor or lender to restructure their debt obligation, which it could include asking for moratorium on loan repayment, reduction of interest rates, or changing the frequency of debt service to enable that business be able to continue afloat and meet its obligations in the future. Now, for debt refinancing, what are the reasons why a company will want to assess debt refinancing? Well, the reasons are quite similar for debt restructuring. However, this is only available for companies in good financial position. So reduction of interest rate on loans, refinancing can also be used to consolidate existing loans. It can also be used to change the loan structure and also free up cash in the business. And as earlier mentioned during the overview of debt restructuring and refinancing, debt refinancing is assessed by a company in a better financial position, and the borrower or that company uses proceeds of that new loan, which usually has better terms, to refinance their existing loan. So then that gives them the opportunity to benefit from all these points that we've just discussed. What are the types or the methods of refinancing that a business can assess? Well, there are 4 key types that we want to highlight in this presentation. The first one being cash out. How does this process work when it comes to refinancing? Well, cash out basically allows companies to assess equity refinancing. So let's take, for example, a real estate company that has used a real estate property to secure its debt obligation. We know in our part of the world, properties increase in value with time. So after a number of years, the value of your property has increased. That value accrues to you as the owner of the property. So it's basically your equity stake in that property. A borrower can approach its lender to refinance that equity stake in the property. So you are cashing out value from the collateral that you have with that lender. And it's an option that many businesses have used during these times of COVID when they are hard pressed with cash. They may have some properties that they bought themselves without bank's money or obligation from a creditor. So they approach banks to say, I have this asset. This asset generates some cash flows. I bought it with my own money. Can you refinance the equity stake in this asset for me then to use the business to support my operation? So it's one option of debt refinancing that can be assessed. The other option is cash in. And basically, when a company with improved financial position has sufficient cash flows and some surplus, they use the surplus to pay down their debt obligations, to reduce their loan amount, to improve their loan to value ratio. One that is quite common in our markets is the rates and terms refinancing. So a borrower will approach a lender or a creditor to say, I have this loan which has remaining tenor of 2-3 years. Can you please give me a new loan of 5 years? But because I am in a better financial position now, instead of charging me interest rate of A, we want you to charge me interest rate of B. As earlier said, risk and reward. So as your risk profile improves, you stand a chance of accessing better loans with lower interest rates. So then you use the proceeds of that new loan to pay off the existing loan, which may have higher interest rates. The last one we want to highlight is consolidation. Basically, companies agree that managing several loans could take time. So then they use one loan to refinance all the other debt obligations into one facility so that the management and the running of that loan will be easier for them to consider going forward. The process of assessing such a tool is also same as debt restructuring. You need to understand your position, you reach out to your lender, and then you negotiate the term. The only key difference we want to highlight is that for refinancing, you necessarily do not have to approach your existing lender. You can approach another bank, another lender, raise the money, then you pay off your loan with your existing lender. The advantage and disadvantage are listed on this slide. It gives you opportunity to get lower interest rates, lower repayment. You can convert a variable or a floating interest rate loan to a fixed rate loan. You can also obtain shorter loan period depending on the needs of the company. There are also disadvantages. Shorter loan repayment means that you pay more interest, and then reducing equity in your assets by cashing out also means that you reduce your ownership or your level of ownership in that particular asset. Switching your loan from floating to fixed also means that in an environment where there is improved economic condition and interest rates are going down, you will not be able to benefit from such situation unless you refinance your loan again. One key thing we want to highlight when it comes to the refinancing is that you need to consider the cost of the refinancing before assessing it, because doing so will help you to know whether it's the right decision or not in terms of finances. So in conclusion, we've seen that debt restructuring and refinancing are two distinct processes. Debt restructuring is used when a borrower with a viable business is under such temporary financial stress that prevents them from making timely repayments on their loans. So they use debt restructuring as a tool to reorganize their obligation to give them that relief. And this is a win-win for both the borrower and then the lender. For debt refinancing, a borrower in a better financial position, that is on the right side of the credit score scale, can access a new debt with better terms to pay off the existing debt. But before a borrower does that, key is to assess the cost of the refinancing before making that decision. So that brings us an end to our presentation. We are aware questions will be addressed later on at the end of the program. And therefore, at this point, we say a big thank you for being with us on this presentation.
Thank you very much, Mr. Obed Ashie, for this educative delivery. Yes, you are right. There will be time for questions. So participants are kindly advised and encouraged to write your questions in the chat box, or you can note them down. After we finish listening to the second speaker, we will have time for questions and answers. So thank you very much once again, Mr. Obed Ashie. I've learned a lot. The need to understand your needs. The need to not wait until your debt crystallizes before you realize that you don't even have funds to pay. And then they need to consider the cost of the refinancing, because once it's good, it leads to a win-win. There's cost to everything, right? So I've learned this among other things. I will kindly introduce our second speaker, who I consider my very, very big senior in the industry of accounting. So the next speaker is the immediate past country senior partner of PwC Ghana. And and a former member of PwC Africa Governance Board. He has more than 30 years of practice and consulting experience in corporate finance and recovery, financial, operational, and forensic auditing, arbitration and mediation, and organizational restructuring and performance improvement engagements in both developed and developing economies. Since his retirement from PwC, he is currently the administrator and liquidator for the United Steel Company and has developed a portfolio of board roles in the consumer, financial services, oil and gas, and governance sectors. He currently serves on the board of various organizations, including Guinness Ghana Breweries as chairman, MTN Ghana as a board member, KEK Insurance, Pay Switch Company. He's also the president of the Ghana Association of Restructuring and Insolvency Advisors, GARIA. He's a member of the University of Ghana Alumni Council and a trustee of the Achimota Golf Club. He has previously served on boards of Standard Chartered Bank PLC, Ghana National Petroleum Corporation as chairman, and the American Chamber of Commerce, Ghana, as vice chairman. He was a member of the Professor Justice Dateban Business Law Reform Committee of Experts, who reviewed the Ghana Companies Act and the Body's Corporate Insolvency Act. He was recently honored with a Doctor of Science by the University of Mines and Technology, Takwa. Our second speaker holds a BSc degree in administration from the University of Ghana and an MA professional accounting from the Loyola College, Maryland, United States of America. His professional certificates and memberships include the American Institute of Certified Public Accountants, Institute of Chartered Accountants, Ghana and Sierra Leone, International Insolvency Institute, and Insol International. Our speaker is a founding member of the Insol International Africa Roundtable. Ladies and gentlemen, participants, please let's welcome Mr. Felix Addo, our second speaker for this webinar.
Thank you, Eric. Good afternoon to the panelists and good afternoon to your audience. It's indeed a pleasure for me to join you this afternoon at the UK Ghana Chamber of Commerce forum to discuss restructuring, refinancing, and debt, specifically debt restructuring and debt refinancing, in addition to general corporate restructuring. Let me say that it's also a pleasure to see Chief, who used to work with me way back then, but decided life is more exciting in the hospitality business, so he moved on. Okay. Now, I'm glad to see that at least this forum is come on at this time. As our first speaker indicated, and as our chairman also confirmed, the timing couldn't have been more right. It's perfect, so to speak, for us to engage in discussions around this subject area. Because of the COVID recently, and because of what we've gone through in terms of the banking sector reform, changes we had the last few years. Okay. Now, I'll be speaking on the CIRA, that's the Corporate Insolvency and Restructuring Act 2020. This act actually had its origins in the 63 Act, the Body's Corporate Insolvency Act, which we had modified, that's GARIA, and all the other champions in this space who worked assiduously to get us to modify the 1963 Body's Corporate Act. My presentation will go along the lines of what you see on the table now. I've specifically focused on administration and restructuring. because that's the topic of the day. But the Act itself has other elements like liquidation, cross-border insolvency, insolvency services division, and all. But my presentation today will be basically on the administration and restructuring. I will discuss a couple of the critical financial provisions in the SIRA, and then I will discuss also elements which have been provisions which have been put in place to ensure that we don't abuse the process of the SIRA. I will spend a few minutes discussing the implementation is SIRA faces, and then I will take any comments. Now, prior to the enactment in 2020 of the Corporate Insolvency and Restructuring Act, there wasn't any general legislation providing for restructuring of companies. Although there were selected acts dealing with specialized deposit-taking institutions, i.e. the banks, and insurance companies. There's companies with specific legislation. Okay. At 930, for example, had provisions of administration for banks. Same applied to Act 20, the Insurance Act, which also dealt with specific statutory arrangements for management of cases where an insurance company goes or goes under. That's at 708 at 206 1061. So there was a gaping hole in the law, and this is what the SIRA Act to fill for all the other companies out there, which are neither insurance, neither banking, or specialized deposit-taking institutions. This is where the SIRA kicks in. Now, in 2008, the Business Law Reform Committee of Experts was established by the then Attorney General under the chairmanship of Professor Justice S.K. Tebang. The main business of this committee was to reform Companies Act. About the same time, the AGM commissioned a report from GARIA. By the way, GARIA has been in existence for quite a bit, 2005, 2006, okay, asking us to look at reviewing the then Corporate Act and make recommendations under the general umbrella of the Committee of Experts, so that government will look at all two critical business laws. The recommendations of GARIA became the basis for the subsequent SIRA Act. Now, the options available to a company in distress. What this new SIRA Act was added a new element, which we call administration or restructuring. The other provisions, i.e. the scheme of arrangements, the formal arrangements, informal, receivers, managers under the Companies Act, liquidations, both private and official liquidations. Now, the Bodies Corporate Act was basically on official liquidations, okay? But the private liquidations, that is solvent companies liquidation, came under the Companies Act. Okay? The administration element was added on board to our tool to help us restructure or turn around companies in distress. The purpose of the Act is clearly stated in Section 1 of the Act. And basically, it provides a legal regime for the administration of the business, the property, and affairs of a distressed company in a manner that provides an opportunity for the company to, as much as possible, continue in existence as a going concern. So, whereas the previous Act focused on liquidation, and that is winding up the affairs of the company, this Act gives us an option to turn around a company and allow it to continue as a going concern. The Act also provides a temporary management of the affairs, business, and property of a distressed company, provides for an administrator to be in charge of this company, this distressed company. In other words, unlike the American Chapter 11 Act, which allows the company officers to be in possession of the turnaround exercise, in our situation, we look more at the British type, the administration, which puts the turnaround exercise in the hands of a separate entity, a separate person. The Americans put the management of the affairs of the company in distress under the operations of the same officers. The argument being that they know the company best. And so if there's a temporary relief, they will be the best people to optimize the advantages and get the company out of the distressed position. The other argument, which was what prevailed in the Ghanaian context, was that you are not going to give a temporary relief to the same directors or company officers who got the company in the, so to speak, in the distressed position in the first place. Okay. But what you're giving them is a license to continue doing what they did poorly in the first place. Okay. So we opted for the British one, which allows us to put or get a separate person qualified, whom is described as an IP in the law, to run the affairs of the company when it's under administration or restructuring. Now, another element is placing of a temporary freeze on the rights of creditors and other claimants against the company. Obed, in his presentation, explained to us how you can secure a moratorium with your bankers when you approach them, work out an arrangement whereby they will hold up payments for some time, extend the period of your payback, and work flexible term periods and interest rates for you. Now, in the case of this situation, it's not only one financier, not only one banker or lender you are dealing with. The company is dealing with the totality of all the lenders out there, and also all the creditors, supply creditors, trade creditors, and the like, who the company owes. Okay. The administration arrangement provides that umbrella. It brings all the parties together and they work out what we call a restructuring plan as against one-on-one. The development and implementation of a restructuring plan allows for a better return for the creditors and shareholders of the company. And that, in theory, allows for a better result than the immediate winding up of a distressed company. Now, when a company goes bust, we all know who suffers. First, the creditors, they lose all their monies. Then the staff, you lay off all the employees. Then, of course, the economy as a whole suffers because that vital service or key role being played by that particular company is taken out of play. And of course, it affects the general growth and GDP of the economy as a whole. But if we're able to turn around the company, that means that we'll be able to at least keep the company going, and the company will be able to pay taxes, be able to service all its creditors. It will also pay the staff. And that's the whole idea of having this provision. Now, this table basically gives the 5 key elements of CIRA. The first box is administration or pillar. Pillar 2, which is official liquidation, discusses all the necessary elements of what happens under liquidation. Another pillar of this new law is what we call the provisions relating to the Insolvency Services Division. the setting up of insolvency practitioner as a profession and supervision of IP or insolvency practitioners. Now, the next pillar is the schedules relating to the cross-border provisions. Okay. And then final pillar relates to agreements and miscellaneous elements. Okay. This presentation today focuses, as I said earlier, on the administration and restructuring. As I said earlier again, the CIRA Act does not cover the banks, it doesn't cover the insurance companies, it doesn't individual bankruptcies for that matter. And believe it or not, we do have a law pertaining to individual bankruptcies, even though we yet to find somebody who officially is described as a bankrupt person in Ghana. The law also doesn't apply to metropolitan, municipal, and district assemblies. These are essentially sovereign debt. Now, which companies go into administration? According to CIRA, Section 1, Subsection 2, a company is placed in administration or restructuring if the company is unable to pay the debts or current obligation of the company as the debts or obligations fall due, even if the total assets of the company exceed the total liabilities of the company. In other words, the company may be balance sheet asset rich, but because it cannot pay its obligations as they fall due, all right? And this is working capital, what we describe as the working capital liquidity test. Alternatively, if the company has a negative net, in other words, the liability side of the financial statement is more than the asset side. So it's negative net worth. Incidentally, under our laws, if a company is owed more than 10,000 cedis currently, and it sends you a bill demanding payment, and within 30 days, the company is not able to meet that requirement, that's pay on the debt, you can be forced into liquidation. So for 10,000 cedis, any company which has not been able to pay up within 30 days, the creditor can apply for liquidation processes to be started. Now, who qualifies or who appoints the administrator? First, the administrator has to be a natural and he has to be a qualified person. And later on, I'll mention some of the qualifications go into being an administrator or an IT, as we call it. But the company itself, the distressed company, can pass an ordinary resolution. Okay, that have to be special. Okay, the directors can pass a simple resolution saying that we want to put the company in administration. Now, in the case there is already a liquidator in place, the liquidator may decide to opt for administration for various reasons. Company or the fortunes company stand around, the liquidator may recommend that the company is put in administration. The next person who can apply for or who can appoint an administrator is any person holding a charge over the whole, substantially the whole of the company, or a receiver appointed by that person. In other words, secure credit can also ask for administrator. The court, but the court will have to be on the instigation of any of these folks, especially the registrar. But the company does not have to go to the court to appoint an administrator. A simple resolution by the board can put a company in administration. Now, the role of the administrator basically is to turn around the company, all right? The company could not previously pay up on its debts. It had problems securing working capital. having problems managing affairs. The administrator comes in, and his main task is to turn around the company. The law says that the administrator shall have control of the business, the property and affairs of the company. The administrator is required to investigate the affairs of the company and consider possible ways turning the company around in the interest of creditors, employees, and shareholders. So the critical stakeholder group for the company all have their interests to be balanced by the administrator. The administrator shall carry on the business of the company and manage the property and affairs with the object of salvaging the business in the interest. He or she may terminate or dispose of any of the property and may perform any other function and exercise as if the company were not in the administration, any authority to the directors or what the officers can do. Now, this timeline, critical line for a distressed company, from day one when the company appoints an administrator, on day 7, the directors have to give the administrator a financial position statement. Now, the law requires that the statement should be very much under IFRS. For which are around pretty decently, that should not be a problem. But in real life, distressed companies are seldom very efficiently. And so you have challenges with the financials. In fact, in many instances, the directors or the company may not be producing accurate and complete financials. But the law requires the directors, as much as they can, produce financial statements so that the administrator may have an appreciation of how bad the situation is, the company. On day 10th, the administrator has to convene what we call the first creditors meeting. And at the first creditors meeting, all the creditors of the company who are on file, we have to be notified. Also, the administrator we have to take an ad in the national newspapers, alerting everybody is being put in administration, and the first creditors meeting is taking place. What happens on the first creditors meeting is that one creditor group, and I'm talking about all creditors, whether you have securities or not. On the 10th, the creditors meeting, the creditors will also have to form up to 5% creditor committee, which will be like a sounding board for the administrator. Okay. Now, the 28th of the creditors of the administration, the administrator will have to give notice for what we call a watershed meeting, which had to be done within 7 days after the convening period. The convening period is day 1 to day 28. So within 35 days of the administration coming into being, you have the watershed meeting. Now, the watershed meeting is the most critical meeting after the first creditors meeting. And generally at that meeting, the administrator will have to present the restructuring agreement. This is the agreement as to what best will work for the company according to the administrator. Now, the creditors have a couple of options. They can decide to terminate the whole administration at this meeting. They may say, yes, we accept it fully, or they may partially accept. Okay. And this is the new restructuring plan for the company. Okay. Now, the restructuring plan includes various elements. Okay. It's very similar to the plan Obed discussed, but that was a one-on-one between the company and the the debtor. Okay. But this one is for the entirety of the company and its creditors. Okay. It has to give, apart from the basic data identifying elements, it has to estimate what monies or available assets are going to be used to pay the creditors. It also will have in its element the nature and duration of any moratorium, the extent to which the companies will have to be released from its debts. Okay. There definitely will have to be a shaving off of some of the debt, interest and penalties and the like generally are candidates to be waived. The conditions for the restructuring agreement to come into operation. Okay. One of the conditions may be that we need to secure new working capital from either the creditors, the existing creditors, new companies, new lenders, or we need fresh money from the owners of the company. Okay. If this does not come into being, it means that the restructuring agreement will lapse. Okay. It also, we have the circumstances in which the restructuring agreement will be terminated. It will have a cut-off date for admission of all creditor claims, what we call the proof of debt. Okay. The creditors, we have to resubmit the claims they have on the company. And last but not the least, in fact, this is the most critical part, the funding of the restructuring plan, including any post-commencement financing required. Now, once the creditors agree on this plan, it has to be executed, it has to be signed off with the company within 21 days of the watershed meeting. If there's no agreement, there's no execution of this plan within 21 days, then the administration shall be converted into a liquidation. Let me spend a few slides on the selected financial elements in the law. Okay. The first is the classification of debts and priority of debts. Those of you who are familiar with the Bodies Corporate Act know that there's a ranking of distribution of dividends or payment of debts. Okay. There's a new class A, and it's now called the post-commencement finance. So essentially what this means is that if the company is in administration, any new debt taken on board, like working capital for the company to operate and all, takes superiority over existing debt of any kind. Now, this feature is so important because a company which is distressed, 9 out of 10 cases, there's no new debt coming on board. It may come from the shareholders. If they believe in their company, they may advance some more finance. But to go out to the market and borrow is almost non-existent. So this provision allows for the company, the distressed company, to go out there and borrow fresh money to finance operations, because you have to work and money to be able to pay off and service those debts. All right. And this is the one provision we need to get our bankers, the Absas of this world, to know, because we realize that most of our bankers are not used to this post-commencement financing, in this, at least in this environment. Okay. The debt is as secured as it can get because it has superior claim on the assets of the company. Right. So when your administrator comes to you asking for working capital debt post-commencement, you have to understand and place the risk in its proper category. Second, in the distribution hierarchy is what we call preferential debts. There are essentially 2 main groups of preferential debts. One is debt owed to staff of the company during the whole or part of the 4 months prior to the company going to administration or liquidation. And then the second group are taxes, utility payments, GRA, rates, all such monies owed to the Republic and its principalities, municipal assemblies, district councils and DCs and the like. Yeah. So that's class B. Now the next class, which is C, is secure debt. Okay. And it's debt which is secured over a fixed charge against an asset of the company. Interestingly, the ranking doesn't make provision for floating charges. Okay. And floating charges are not the same as fixed charges. Okay. This is very important. Secure debt in this context means fixed charges against assets of the company. We have other ranks of debts, but for time saving, let me jump on to my next slide. The next item I want to talk about is the post-commencement financing. The post financing is remuneration or reimbursement for expenses or any other amount of money related to employment that becomes due and payable by a company to an employee during the course of the administration, which is owing to the employee. In other words, during the 4 months or so, when during the course of the administration or restructuring period, any debt which is owed the employee has top rank, class A. Okay? It doesn't cover previous debts or previous salary arrears. Okay? We're talking about during the life of the restructuring period. The second post-commencement element is financing. And this is for our bankers. Financing obtained by the company, including trade financing and venture capital financing during the administration or restructuring proceedings of the company, and which may be secured by using an asset of the company that is not otherwise encumbered. It may or may not be secured as long as it's financing obtained during the course of the administration or restructuring is post-commencement financing. And it has class A rank. So our bankers should take note of this. If an administration or a company in restructuring approaches you, remember that your new debt, your new facility is top of class. Now, I want to also mention about netting agreements. Okay. Netting agreements refer to, and you, the bankers, are very conversant with this. It refers to master agreements, debt under master agreements. Okay. And what it says is that if any master agreement, as approved by Bank of Ghana or SEC, contains a netting provision in that agreement, then in the case of a SIRA or a liquidation provision, that particular debt is ring-fenced. It's ring-fenced and it's not available. That particular debt doesn't become part of the estate for managing the affairs of the distressed company. I will just end here. Well, let me just mention that the law has various protections against abuse, okay? One of them is the company's directors should not get involved in insolvent trading. If you do so, you are liable to go to jail for 2 to 5 years in addition to other penalties, financial penalties, okay? The law has a very enhanced corporate governance structure to make sure that folks who deal in this type of activities are not only qualified, but they can be sanctioned. For example, IPs should have, they should take on board insurance, okay, indemnity insurance, so that just in case they mess things up, the company can take an action against them. The administrator has over 2 years and can reverse any transaction which taking place 2 years before the administration comes into being. The administrator has very extensive investigative powers, and within 21 days, he has to come out with a report whether the company directors abuse the company or there's element of fraud, misappropriation, or any such thing. If so, he has to report to the registrar of companies for further investigation, so that if necessary, criminal sanctions can be brought against the officers of the company. Now, I know Eric is watching the clock. Let me say that we have a few challenges with the CARIA. One is that we need to educate people. And I'm happy Absa is convening. Is it Absa or the UK chamber? Yeah, UK Ghana chamber in collaboration with Absa and ourselves is convening this workshop to ensure that people are aware of some of these provisions. Another challenge we have is the limited capacity of IPs. Most of us double in this phase called IP work, but we're not really IPs. And under the law, IPs have to be trained and licensed. See? In fact, the first set of IPs will be inducted on December 1st. Okay. Only IPs can act as administrators. Okay. Anybody who behaves like an IP, but is not actually licensed to be an IP, can go to jail for 2 to 5 years. Okay. The next element is the inadequate institutional capacity we face currently. Because the law is new, we now have to train the judges, we have to train the lenders, we have to train even the companies to get to be aware that there is this new law and they can take advantage of it. Last critical element or challenge we face is the absence of distress funding. And on that note, I was going through the Financial Times of a couple months back, and it will be of interest to you that of all the various hedge funds, distressed debt was bringing up the highest yield in terms of performance. They were overperforming compared to all the other funds, okay? So that's something our bankers may have to look at. But more importantly, Ghana has to set up venture funds and this type of financing to take care of distressed companies. And I'm happy to say that Absa is looking at taking care of some of these distress lending. Okay. I know I've stretched it a bit, but on that note, I will end here and then take any questions which have come up. Thank you very much for your attention.
Thank you very much, Mr. Felix Addo, for your very educative presentation. I've been a banker for over 20 years, but I've learned a lot today. I've learned about the CARIA Act, about the restructuring agreement, and the priority of debts. I didn't know about the post-commitment financing now having priority over the others. So this is very, very educative for me. And the question why bankers shy away from providing debt to distressed companies. I guess banking 101 that they taught us was that you don't throw good money after bad money. But at least now we know that the law protects any debt that comes when the distress position starts. I think it's a good thing for us to start considering. So thank you very much, Mr. Addo. Hello, participants. The floor is open now. Please, if you have any questions, you can raise your hand. We will call you, we will unmute you, or you can put it in the chat box. I've seen a few questions in the chat box, but I guess I'll exercise my powers as a moderator to ask the first question. Mr. Addo, this question is to you. The general belief is that once a liquidator or an administrator is appointed, then there's nothing that will be salvaged. Then the business is on the path of, being wound down. Now, hearing you, it looks like the Act actually provides a first option of bringing the business to solvency before, if all else fails, then perhaps there will be a winding up. So my question is, practically, has there been an instance in Ghana where an administrator was appointed for a distressed company or asset who was able to successfully run it and bring it back to solvency and is still doing well? That's my question to you, Mr. Addo.
Thank you. The act came into force in 2020. So it's a very recent act. Secondly, we are yet to educate. We had COVID also. So the spreading the good word that rescue provisions are contained in this new act had been thwarted to some extent. Okay. We are now engaging the public and letting them know that there is this provision. So it's a critical challenge for us. I know of about 2 administrations currently going on. One, I am in charge, and the other, I'm told, is a mining services company. Okay. So the jury is still out. We have not yet gone through the full processes. So it's kind of early days to what comes. But that situation on the ground now is essentially because many companies have not taken advantage of this act. And secondly, the act is a new act. Yeah. So spread the word. Next time your distressed company comes around, share with them the possibilities of getting into administration. And yes, a whole bunch of IPs who are licensed and by they are GARIA members, but licensed by the Register of Companies as IPs, who will be available. They are qualified and competent, and they can do the work.
Thank you very much. Well noted, and we'll definitely spread the word. Thank you. Mr. Ashie, my next question is to you before I come to the chat box. In your delivery, you mentioned that companies should not wait for a facility to crystallize before they realize that they are able to pay and run to their banks. Ideally, they should have seen that coming and start the engagement with the bank. What is the advice for companies? How can a company determine that, let's say 6 months down the line, 1 year down the line, I will not be able to pay my facility? Let me engage my bankers now. What tools do you advise companies to use to do this exercise?
Thank you, Mr. Ashie, for that good question. So what companies can do is to have proper financial planning. So every company should know their future cash flows as against their future debt obligations to check if their future cash flows are sufficient to meet their debt service obligation on due date. So immediately you realize that as per your financial planning, then you engage your bankers to have the conversation before it is due date and you don't have sufficient cash flows to make that repayment, leading to default on your loan.
Thank you very much, Obed. Mr. Addo, the next question is from the chat box, Mawenya Gagakuma. It says, can a liquidator so appointed resign his position? If so, what processes are involved?
Okay, thank you. Before I answer Mawena's question, let me add to what Obed said about a company planning, knowing their cash flows and cash outlays in advance. Most invariably, there will be instances where companies will go through illiquid times, okay? And that's why it's so important for cash flow analysis. More importantly, the directors of the company ensuring that the management is on top of the company in terms of their inflows and outflows. Under the CIRA, companies which work, which borrow more money while they are insolvent, and I have defined insolvency broader than when you can pay your debts as they mature. You are liable for a 2 to 5 year stint in jail because you know as the director or an officer of the company that the company cannot pay its debts. And yet you play in the market. You are allowing lenders, suppliers of materials, trade creditors to engage you. Okay. It's a very serious offense to be trading while insolvent. And that is what the law, among others, tries to prevent. So it has to be a robust engagement. You have to be on top of your business and ensure that at all times, you either have made arrangements with your suppliers, your creditors, or whoever, and not lead them on, which of course is very popular among our business folks in Ghana. Okay. Now, to the question of Mawena, yes, nobody can force you to do any work you as a person doesn't want to do. Of course, there may be contractual obligations. You cannot just walk away from your responsibilities, okay? But you as a professional can resign your mandate at any point in time. And so, yeah, you as a liquidator, administrator, and insolvency practitioner, you can quit if for whatever reason the client is not playing ball or for whatever reason. But there are responsible obligations you have to go through. Your contract may say give notice, for example, or you pay a penalty if you walk away, whatever the arrangement you have with your particular mandate, you have to fulfill it. And that's why, among others, the IP has to have a reasonable professional indemnity insurance to cover such arrangements when they occur. I hope I've understood and answered the question properly.
Yes, you
Thank
have.
you.
Mawena, if you have a follow-up question, happy for you to raise your hand or put it in the chat box and I'll read it for you. Thank you very much, Mr. Addo. The next question is for you, Mr. Ashie. It says, why do businesses prefer debt financing to equity financing for optimal cost of capital? This is from Vincent Adai. It says, why do businesses prefer debt financing to equity financing for optimal cost of capital? From Vincent Adai. Mr. Ashie.
Yeah, thanks, Vincent, for your question. What has been realized is that many Ghanaian businessmen prefer to have full control or ownership of their business without allowing further equity investments from other potential shareholders into their business. So because they want to retain 100% ownership, they then prefer to approach banks or lenders to raise financing for their business operation than inviting equity financiers into their business operation. It is encouraged mostly for businesses that are now starting or startups to rather invite or access equity financing in their business operation than debt. And this is the reason why. This saying that equity is patient, but debt is not. For debt, when your debt repayment obligations are due, you are to meet them. And if you're unable, it will result in a default on your facility. But an equity investor can wait to see the business turn around so that they can get their money back through dividend payment. So this could be one of the reasons why businesses may prefer to go to the debt market than raise money through the equity market. But it is recommended and encouraged that where possible, use more equity in running your business than debt. Must say, however, that sometimes it takes more time to raise equity in the equity market than the debt. And that could be the second reason why they prefer to do so.
Thank you very much, Obed. So Vincent, I hope you answered. If you're not, please, happy for you to raise your hand or put your follow-up question in the chat box and we'll definitely read it for you. The next question, Obed, is for you again from Mawenya Gagakuma. It says, in your experience, how common or popular is equity swap in our market? In your experience, how common or popular is equity swap in our market? Obed.
So in the Ghanaian market, yes, there are some few examples, but it's not common. However, I must say that there are investment firms that are prepared to take equity stake in businesses. So depending on kind of creditor or lender that you have in your business, you may want to engage a firm that takes equity risk in companies. And what you could do is that you can use the proceeds from that investment to pay off your bank loan, assuming you secure the loan from a bank. So in that instance, you are still achieving the debt equity swap, but then not with the same lender or creditor.
Thank you. So Mr. Addo, please, there's a question for you from Equia. He says, how feasible are the timelines provided in the Act for the administration process?
Good question, Equia. There are very strict timelines in the Act. And the reason being that the company is distressed. And in a way, the IP is like a doctor who is performing surgery. Time is of the essence. Time is everything, literally. Okay. And you have to do your very best within the timelines given in the Act to be able to turn the company around. They are practical. They produce a lot of pressure on not only IP, but also the organization. To some extent, there are outside elements which is not under the control of the administrator. For example, raising financing. Okay, that is more like an activity totally outside the control of the administrator or the restructuring officer, and that may take some time because you apply for the money, it goes through various boards, reviews, and before you are granted the loan. Okay. If it's the shareholders, the company is hemorrhaging, literally. And so as much as possible in the restructuring plan, and as you could see, within 35 days or so, there must be a restructuring plan, all right? Within 7 or so weeks of being appointed as a liquidator, you should have a plan, 6 to 7 weeks, as to how you rescue the company. It may not be perfect, but that's fine. It shows the urgency with which is attached to the necessity of doing what you have to do, that's turning the company around. So it's understandable that the timelines are very strict and need to be complied with. But you do your best as an administrator, and you use the guideline, the timeline, as what you have to accomplish by when. And the creditors, everyone is aware of timelines, so play to that because you need to the company. So yeah, they may not be very convenient or flexible, but at least they give a roadmap as to what you have to do by when. And you, the administrator, we have to try and comply, do your best to comply with those timelines. Thank you.
Thank you, Mr. Addo. There's another question for you, Mr. Addo, from Justice. It says, to what extent is the new debt, I'm sure he's talking about the post-commencement financing.
Yeah.
So what extent is the new debt superior to existing debt in a distressed situation? Is this to suggest that fixed charge holders also forfeit their rights to a new lender, even if registered?
Good question. The fixed charge holder does not forfeit his rights. So, all we are saying is that the post-commencement financing comes first before, it comes prior to the fixed charge holder's debt being serviced, all right? Remember that previously, the same ranking prevailed apart from the post-commencement, which now took top order, under the at 180. At 180, the prefs were number one. The preferential debt owed to the state, to the taxman, to the municipalities, utilities, and all. they were priority 1, priority A. But with this new law, the post-commencement element, okay, becomes number 1. It's imposed, superimposed over all the previous ranking. And so secure debt, which used to be number 2, is now number 3. So yes, we will take care of number 1, which is post-commencement. Because without new capital, without new working capital, you cannot turn the company around. Okay, that's the practicality. You need to go out there and raise fresh monies to use as working capital or buy that equipment or whatever raw material, whatever you need to do for the business to continue operations. And that's why it makes sense to place number 1 superior to all other debts, right? Because we want the company to be saved and you need working capital to save it. And so, yes, you have to get new capital, and that's why it's number 1. But assuming things don't work out and the company eventually goes into liquidation, after the post-commencement is paid, the prefs are next in line, and then third will be the secured creditors. That's when the secured creditors come in. Unsecured creditors are class H, all right? And they go into the pool. Whatever is realized after the superior creditors have been paid, that's what gets divvied up among the unsecured creditors. I hope it's clear.
Yes, it is. Thank you very much, Mr. Addo. At least for me, with my banking experience, I think if there's one thing I'm learning from you, whilst yes, the general saying is I don't throw good money after bad, there could be instances where there is need for you to at least put in some money to help the company recover and then pay you all your facility. Because if the company is not able to, let's say it's a manufacturing plant, if it's not able to import raw materials to manufacture and sell, then it cannot pay you. So yes, you may have given the company money, the company may be struggling, but there could be wisdom sometimes in finding the right balance between how do we give this company some working capital to be able to operate and to be able to pay us our money in full. So I've learned this from you as well. Thank you very much, Mr. Addo. Thank you. Obed, I think there's a question. It says, hi, Obed, in the absence of cash flow projections from a customer. In fact, this question will go for both of you. So Obed, that point, if Mr. Addo too, I would like to hear his view from the liquidated side. In the absence of cash flow projections from a customer, is it safe to rely on historical performance to determine repayment capacity? In the absence of cash flow projections from a customer, is it safe to rely on historical performance to determine repayment capacity? Obed first, and then Mr. Addo.
Thanks, Eric, for the question, and thanks to the participant who asked the question. So every business owner understands their business performance better than anyone else. So although they may not put their business projections on paper, having a conversation with them can give you an idea of where the business is trending. So based on that conversation, you as a financier will be able to put some numbers to paper. But the question is, how critical is their historical performance with the financial projections that you put together based on the conversations with the client? It's actually very critical. The past does not necessarily determine what the future is, but it gives an idea whether the business will be able to achieve their future projections or not. So let's take, for example, a business that on a yearly basis is earning on the average of 10 million Ghana cedis in revenues from your business operations. Now, if the same business tells you that in next year, that is the next financial year, I'm going to double my revenue to 20 million Ghana cedis. The question is, what is fundamentally changing in the business that will lead you to double your revenue in the subsequent or the following year? So the historical projections or historical performance is helping you to sort of sense check what future projections the company is giving you. So historical projections, historical performance are quite critical to sort of determine whether the forecast or the projections the client is giving you are realistic and they are achievable. Because as a financier, you are lending into the future and you'll be paid from future cash flows. So if your assessment of the future performance of the business is challenged, likely you, the financier, may be leading the business into a financial distress because you give them a loan that they will not be able to pay from their cash flows.
Thank you, Obed. Now we'll hear from Mr. Addo.
Yeah, thank you, Eric. Now, as Obed correctly put it, you are learning towards the future cash flows, okay? And that's the focus of the new administrator who comes on board. What you've done in the past is good history. It gives you a trending and all that. But the focus of the administrator is to literally come on a clean slate, start with a very clean slate. And that's where the restructuring plan kicks in. The restructuring plan will look at what resources the company has, what it's supposed to do, when, how, and whether the market will be able to generate enough revenues based upon what the administrator or the new company, quote unquote, is going to do. And so entirely, for all practical purposes, the new administrator is going to look at future. Everything is futuristic. How much free cash flow will be generated, how much is going to be used to service existing creditors, existing company operations, working capital, and to, if it's 6 months, 1 year, 2, 3 years, whatever the time period for the restructuring plan will require. How much shaving off of existing debts and liabilities, all right, going to be taken into consideration. And that's where the new administrator comes in. He is not saddled with the historical, not at all. The historical, of course, is a guidance as to what possibly could be done with this particular company. But his focus is his new business plan, his restructuring plan, and what free cash flows will be generated to service both new debt and old debt. And that is paying off, as agreed in the restructuring plan, to the existing creditor population. Thank you.
Thank you very much, Mr. Addo. I don't see any hands. I just see a last comment from Mariana to you, Mr. Addo. It says that, thank you, Mr. Addo. I believe from your vast experience, you will encourage all IPs to fulfill their mandates no matter how difficult the job is. Thank you very much. This is from Mariana. I'm not sure if you want to react to this.
Let me also thank him. I believe he's a GARIA member, and that's why he's so charitable with me. But thank you, Mawina. I really appreciate that. And as you can see, the qualifications of an insolvency practitioner, I hope the sharing is coming through, are very steep, okay? To be an IP under the new law, under SIRA, you have to be, among others, a chartered accountant, a lawyer, or a banker, and be a member in good standing. So for all of us who last read a journal from our association, because we've not been subscribing and paying our dues several years ago, you need to reactivate your membership and do your continuing professional education, okay? You need to be certified as an IP. You need to have a professional indemnity for the performance of your assignments, and you should have adequate time and experience to carry out the assignment. Don't do what most professionals do. In other words, take on board every job which comes your way. At the end of the day, you leave the client hanging. No, for administration, because of the distressed nature, and remember that every day the company is losing value. Because of the distressed nature of the company, make sure you have adequate time to do the work. Otherwise, don't take it on board at all. Okay. You also not be disqualified as a director. Okay. Remember that the Companies Act, if you were a director of a company which goes under, is liquidated, or the Bank of Ghana pull your license and the like, you are forbidden from applying to be a director or an IP for 5 years. That's for the first instance. The second instance is 10 years. Third time around, you are barred forever from being a director in Ghana under the law. Okay, because we want responsible people, people who appreciate the weight and the sanctity of the fiduciary responsibility they take on board as directors, or for that matter, IP practitioners. So yes, Mr. Mawena, we want proper insolvency practitioners to do the work and do it properly and professionally. Thank you.
Thank you very much, Mr. Addo. Thank you very much for very fruitful deliberations. At this juncture, I will hand over to our Honorable Chairman, Mr. John Ufuo, to give us his closing remarks.
Let me start by thanking Mr. Felix Addo and Mr. Obed Ashie and yourself, Eric, for steering us through what has been a fantastic webinar. As I said at the beginning, the timing of this webinar couldn't be better. The one thing I didn't hear anybody talk about is the situation of force majeure, where the company effectively ceases to trade because of an act of God. And that is what we've had with COVID. And obviously, recovery from COVID is also taking time. But to sum up, what participants have been given is a multifaceted look at the options that are available to both businesses and stakeholders, as well as insolvency practitioners in a situation where the business is distressed. I think from the point of view of businesses, the critical thing is to be self-aware. So businesses have to employ best corporate practices. The books have to be kept properly, forecasts have to be done, and most importantly, businesses have to assume responsibility for their survival and sustainability. I think Mr. Addo passed a comment somewhere along the line about our business people not necessarily practicing the best ethics or integrity. It's important that for the business to be sustained and also in the interest of all stakeholders, as those people in a position of authority have that integrity to first approach their bankers or their lenders before a situation of distress. In which case, the options that Obed outlined earlier about restructuring or refinancing are available. But I think it's also very interesting that Mr. Felix Addo has outlined to us other options that are available. There are businesses with assets which are way in excess of what has been borrowed, especially in a situation of force majeure. I mean, if you haven't worked for a year, you haven't worked for a year. Clearly, you're not only distressed, you are insolvent. And the option that GARIA provides now is a group of qualified individuals who understand the situation and the tools that are available to help the business turn around. So this is for the businesses. Yeah, this is not necessarily for other stakeholders such as creditors. Business can vote itself into administration and get the needed support and negotiation skills to turn the business around. And that is very important. From the standpoint of, if you like, other stakeholders, and primarily, let's say, the lenders and the banks or suppliers, yes, you may put the business into administration, but don't forget, while you're doing that, you might be cutting off business for the future. So this option is a good one, but should be used as a last resort. It's important that we've had this discussion because it sort of touches on the responsibilities of all those involved, all the stakeholders. And I would say that we continue to have this discussion, but maybe even include other options that are available. I mean, clearly, we talked about debt and securitization. I mean, there were questions about debt and equity swap. Again, that is part of, if you like, our business landscape, which we haven't developed. So whereas GARIA is very, very, very important, which we all have to learn, whether we are businesses or lenders. Other forms of funding, whether through the markets or whatever else, should also be examined because they play into the same space. They may sort of open other options for the practitioners and insolving practitioners to turn around the businesses. And ultimately what we all want, whether we are government, investors, owners, lenders, or whatever, is to grow wealth in Ghana for Ghanaians. And the discussion really centers on how we sustain what wealth there is and how we progress into the future. So I can't thank Obed enough. I can't thank Mr. Felix Addo enough. I think there's a lot of takeaway from this webinar, and I'll urge us to continue the discussion. It's a very important one, which really, unfortunately, we're not giving a lot of scope and leverage to, but we all need it. For us in the hospitality industry, we've suffered force majeure, and I'm not quite sure how we are coming out of this. We're coming out one way or another, but I think it's been a very informative discussion. And I hope from what we've learned today, we can all take many, many, many aspects or different cuts of the discussion away to help us ensure that we come out better than we started at the beginning of the discussion. So thank you. And I will hand you back to Eric.
Thank you very much. Thank you. Well, as the saying goes in a traditional parlance, opening, I think Chairman has said it all. So at this point, I'll kindly remind all of us to please follow the UK GCC portals. The annual business climate survey, which is an annual survey conducted by the UK GCC, is currently ongoing. As you can see on the screen, please, if you visit the site, you see it, and please, we would like to hear your views. So please go onto the site and give us your views about the business climate. Policy makers, the government, use some of these things to formulate policies. We are kindly encouraged to go in there and share your views with us. Now, just a brief about the UK GCC. For those of you joining for the first time, the UK Ghana Chamber of Commerce was established in 2016 with the support of the UK's Department of International Trade as a member-based trade association to facilitate and promote bilateral trade between the UK and Ghana. There are three main platforms of networking, advocacy, and trade services. So under networking, the UK GCC hosts several events throughout the year, one of them like this, giving its members the platform to build and raise their profile, to get invaluable personal referrals and word of mouth and all of that. Now, under advocacy, as a strong and reputable and most recognized voice of the UK Ghana business community, the UK GCC directly engages with both the Ghana and the UK governments, policymakers, opinion leaders, and all relevant stakeholders by lobbying and advocating on the interests and concerns of its members. And as a trade service, the UK GCC facilitates bilateral trade between Ghana and the UK through advocacy, capacity building, market research, etc. So please, if you are not a member, you are kindly encouraged to register. The link was, if you reach out to any of us, we're happy to link you. So at this juncture, we want to thank the organizers. We want to thank our chairperson, our speakers, and you, the participant, for giving us 2 hours of your time. Until we meet again, God bless us all. Thank you very much.